Hi, this is Wayne Zell, and welcome to Blueprint for Wealth, your half hour of special guests and special topics that hopefully help you realize your personal dreams of wealth and freedom. And today, my special guest is my friend Eli Cohen, who is one of the founding principals of GenTrust, a wealth management firm with offices in New York, Washington, Florida, and now Puerto Rico, of all places. And that's pretty cool. So have you been to the Puerto Rico office yet, Eli?
I have. I travel less with COVID, but I've been probably a half dozen times.
Well, welcome to the show. I really appreciate your being with us today. It's going to be an education for all of us to hear what you have to say.
Thrilled to be here.
So a little background on Eli. I mentioned that he's with GenTrust, but he's also the partner in charge of catenary alternative asset management. So we're going to talk about alternative investments today, which is going to be kind of cool. And I'll try to give a background on alternative investments in the educational moment at the end of this segment. But amazingly, Eli is a graduate with an AB in economics from Harvard College. Then he went to Harvard Law School and Harvard Business School simultaneously, effectively, and got his JD and MBA from Harvard. So for some reason, I thought he'd end up being the head of the Department of Justice or Attorney General of the United States, but instead he's running a wealth management firm. So what I wanted to know, Eli, is how did you get into wealth management from Harvard?
Well, everything's a winding story, but I after graduate school, I was at Lehman Brothers in structured credit. Left there a month before Lehman failed.
What is structured credit, by the way?
Well, credit derivatives. So we were at the heart of the financial crisis. My little sliver of the Lehman business was making money hand over fist, but we were arbitraging credit ratings while packaging subprime corporate debt and subprime credit and moving it out off the balance sheet.
Right.
And so we were at the heart of the financial crisis. I left there to take a job in DC, sort of better lucky than good, gave notice in May of 2008, worked June, July, moved my family back to DC in August, and watched Lehman go under in September, and joined an institutional investment business called Strategic Investment Group, where I helped manage alternative investments there, about $10 billion of alternative investments by the time I left. And I left to start GenTrust with two partners in New York and two in Miami. It's really the brainchild of my partner, Jim Besaw, who had run rate derivatives at JP Morgan and Barclays, and then helped build a hedge fund called Element Capital, which is now the largest macro fund in the world, I believe. And how did I get here? I got into wealth management because Jim, who I became friendly with doing due diligence on Element, said to me, nobody I know who started their career inside an investment bank working on a trading floor has ever hired a bank to manage their personal money. And I realized I resembled that remark. I would never have hired Lehman to manage my own money, but also so did everybody I knew. And so we had an interesting network of proprietary traders, hedge fund principals, private equity partners, who knew of the conflicts of interest or experienced sort of firsthand the conflicts of interest in that bank model. And we thought, man, we could do a better job than that. Those guys want to talk to people who invested for big institutions, taken risk, sat in a risk seat in the parlance of the industry for a living. And the wealth management industry just doesn't have those people for the most part. For the most part, the wealth management industry is dominated by the banks themselves, who have private wealth groups, which are subject to aren't fiduciaries and have a lot of conflicts of interest, in my view, but in the view of everybody who's worked in the banks as well, in my experience. But also, and then folks who've spun out of those institutions to avoid the conflicts of interest, but they tend to be sales folks, they tend to be client service folks. They don't tend to be folks who've taken investing seriously as the core of their career. And so we saw an opportunity. We saw an opportunity to launch a business focused on getting the investments right for our clients and being really sophisticated on the investment side, And we had a client base that we thought would appreciate that, which was our network of hedge fund managers, private equity principals who invest for a living, but don't have time to do with their own money what they'd want done because they're so busy managing big pools of capital for big institutions. And that's who we started our business with as clients, and that's what we've built around. And now, obviously, we've expanded well beyond that because other people benefit from the investment sophistication as well.
How did you come to get to know the guys who are your principals and partners in Florida?
Yeah, well, so that's an interesting one. I mentioned how I met Jim, and Jim already had a bit of a relationship through a couple private equity deals they'd done together. Jim and the Element partners were opportunistic in terms of looking for interesting private equity style deals. And so were George Perez and Guy Sakaris, who were my partners in Miami. And they'd come together around a few deals. What Jim realized, and I realized he was right, was that he and I had never actually talked to human beings before. I managed money for large institutions with boards. Jim managed balance sheet capital for JP and then for Barclays. And the clients of Element all had to invest a minimum of $50 million. So the people he was talking to, the institutions he was talking to were writing very big checks. You all of a sudden you get a hedge fund portfolio manager who says, yeah, I'll hire you. I got 50 million bucks in my own fund. I got 10 or $15 million I've set off to the side that I've been managing with a spreadsheet and a bunch of Vanguard funds, but I could really use your help to make it sing. Great, let's do it. By the way, should I put this in a trust? Who do I talk to about whether I should put it in a trust? How do I think about taxes? All of those things, reporting for individuals, all those things Jim and I didn't know about. Mm-hmm. George and Guy did. They had been Merrill wealth advisors for a couple decades, and they were looking to spin out with an investment team to provide better investment services to their clients without the conflicts of interest. They got tired of essentially B of A saying, look, you get paid if you get these products into your clients. That's not the way they wanted to operate with their clients. But they knew that they needed an investment team that would provide, really first-rate institutional quality, sophisticated investment advice, given who their clients were. And to Jim's credit, and once he said it, I realized he was right. We needed folks who actually knew how to communicate with individuals and families and talk about how their lives change over time and grow with them. And that's how we all came together.
So their client base is really very different from your client base, having experienced some of them. And I think the interesting thing about what GenTrust is offering, and I'd like you to talk a little bit more about that, is the so-called sophisticated investment advisory services and risk analysis that you all do. And so what really I think distinguishes you all from many of the investment advisory firms out there is that in a very small firm, essentially, you've got some very sophisticated people. Tell me about the sophistication that people like Jim and his team and you bring to the investment process that just doesn't exist in the big bulge bracket firms, except at the very highest levels.
Sure. So that's right, that we have a very disparate client base, a lot of variety, but they all benefit from the investment sophistication. I mean, right. When we wrote down at the start of our business, why do we exist? It was sophisticated investment advice without conflicts of interest. And we thought that actually differentiated us from just about everybody out there. So what does sophisticated mean?
Yes.
It means starting with the risk. Most folks sort of build a financial plan, I guess, around a return target or things like that. You can't do that in investing, and no institution would manage money that way. You have to start with an understanding of the level of risk that a portfolio can tolerate, and then build a set of tools to analyze how a portfolio is likely to respond across a variety of scenarios. So, look,
Is that referred to as stress testing?
sure. So, scenario testing or stress testing. Most people, when we found in the sort of private wealth space, when folks are asked, what's the risk in my portfolio, or what's going on with my portfolio, you end up with a pie chart and here's your allocation. That doesn't tell you anything. 60% equities, 40% bonds, 50-50, something like that. Okay, well, there's war in Ukraine. How is that likely to impact a portfolio? Oil's spiked from $80 to $109. Interest rates have started to rally. Equities are down 10% year to date. What happens if Putin moves up to the Balkans? I mean, not to the Balkans, to the Baltics, excuse me. Those scenarios are part of any hedge fund risk management because risks in financial markets are nonlinear, by which I mean two things. First, the relationship between asset classes is not a single number. There are environments in which bonds and equities move in different directions and they hedge each other. And by the way, we've been in that environment for most of the last 3 decades, meaning when growth is high, that's good for equities. It's bad for bonds because interest rates probably have to go up. When growth is low, that's good for bonds and bad for equities. And so they sort of hedge each other. Well, wait a second. If inflation is high, that's bad for equities, especially growth equities, and it's bad for bonds. All of a sudden, they're positively correlated to each other, and they don't hedge each other. You need something else to hedge in that scenario, probably real assets. So those relationships are not stable. They're very much environmentally dependent. So that's one issue you have to take into account. And then the other is the actual moves themselves are nonlinear, which is to say, okay, equities just went up 5. Does that mean bonds went down 2? Or oil went up 10%. Does that mean equities went down 3? You can have, depending on the scenario, something move a lot and some other things not move at all. And so building a balanced portfolio requires not just building out a pie chart, but actually building a set of scenarios, some of which look historically and say, okay, how have things worked in different environments in the past? But also, and there's an art to this as well as a science, but try to proactively say, okay, let's imagine some environments we haven't experienced before, and try to flex these portfolios to see how much they could lose. Because when we sit down with clients, the way clients over the long term don't maximize their wealth is 3 things. They pay too much in fees, they don't take taxes into account, and they hide under their desk when the world gets scary. And the reason they hide under their desk when the world gets scary is maybe they're scared because the world is scary and they have to,
Sure.
Or maybe they're taking too much risk and they got to pay their mortgage, or they have, they got to fund a private equity business call or whatever it is. And they have 20% less money than they thought they had, or 30% or 40% if they're over, in a terrible situation,
Right.
Because the equity market just went down 50. March 24th of 2020, we were buying equities across all of our clients, and you have to be in a position to do that. And the only way you can be in a position to do that is to not have taken too much risk
In the first place.
February of 2020.
Right.
That makes a huge difference over the long term. And understanding the risk inside of a portfolio is where, is what we think we're really sophisticated at. And just backing up.
Yeah.
mean,
I was going to ask you, how do you build models and measure that risk in a way that's different from what everybody else is doing?
So it's not different from what a sophisticated hedge fund would do. We're not, there's nothing, if you looked at our risk systems and you were Element or Tudor or Bridgewater,
Right.
Where I worked at a little while at Bridgewater back in the day. Jim was at Element. Mimi Duff, who joined us recently, was a tutor. It all would look familiar to you. And there's a whole variety of other levels of sophistication that some people have to bring to what they do versus what we do. So we didn't invent this. What I will say is that we haven't found anybody else in the wealth management space that has taken the time to build the systems we have, and you can't just buy stuff off the shelf. So you need something that pulls in every position across every portfolio from the custodians every day. You need a ability to characterize each of those positions and their relationships to each other, right? So if it's a bond, you don't just need the name and the credit and whatever. You need the duration, and you need to break that bond down into its component risks. If it's equities, you need to think about where it is geographically and the size of the company, and sort of map it
and the industry and its vertical
to an index that you can make some assumptions about in terms of how it will relate to others.
So with
then you build your stress tests. And
with inflation going up, interest rates going up, everything being in a state of disarray, war in Ukraine, how are you advising clients today in terms of wealth management?
Yeah, so we entered the year. The other thing about talking about risk all the time, just throw this out there, is that if you talk about risk all the time, you can scare yourself or scare your clients, or make it seem like, oh man, we should always hold cash. Just because we entered the year thinking equities were expensive, technology, growth tech, especially expensive, interest rates likely to go up, and inflation, underappreciated, even though it was certainly a big story across headlines, underpriced in markets.
Right.
It doesn't mean that all of a sudden you go to, 0% equities or 20% equities when your long run benchmark is 50. So for every client, we focus on the risk tolerance that they have. And that's both an emotional thing. How much volatility am I willing to take for my personal portfolio, my family's portfolio? That's very different person to person. Part of the fun of this business is getting to know people like that. It's the same. Every foundation is pretty much the same. Every pension is, you're mapping their, long run liabilities and duration matching it. It's not that complicated. Talking to people about how they think about risk is complicated. And it could also be like, look, I bought a house. I have a vacation home. I just quit my job because I'm starting a new business. Like, oh man, we got to rein in your risk because you got a lot going on right now.
Yeah.
Or like, hey, I just sold my business. I'm sitting on a bunch of cash. Like, okay, well, maybe you have some more risk tolerance. But getting that right is the start. And then, once you have that baseline, whether it's 50% equities, 30% equities, 60, whatever that is, and the mix of real assets and bonds around it, our job then is to sort of tactically tilt based on where we think the environment is, to try to smooth the return stream over time and get as much as we can out of capital markets. And so how did we enter this year? Just as an example, we were overweight real assets, specifically commodities, metals, ags, and energy commodities, in part with concern around what's going on in Europe today. We were underweight equities, specifically growth tech. They were the most expensively priced, and they were expensively priced in part because the discount rate used on their future cash flows was really low because the Fed has kept interest rates so low. And our view was interest rates have to go up to moderate inflation. And so those were sort of the primary tilts. But if you were 50% equity benchmark, we were at 45% equities. We were also tilted internationally because those equities were cheaper, a little bit in Europe, a little bit in emerging markets. And that was a drag on performance in 2021 and a boon to performance so far this year. I think, but all those tilts are around the edges. As long as we are getting the overall risk tolerance right, so that going back to March of 2020, somebody's not calling us and saying, "Hey, man, you got to take me to cash because I can't afford to make, I can't afford to pay my housekeeper. What have you done?" Or whatever. Or, "Man, this is scary. I need to go to cash." It's like, no, you need to be. We're looking at the horizon, and it's a stormy time right now. But that's what you pay us for, is to manage through those times. And I was at Lehman through the financial crisis. My partner Jim ran the largest derivatives book in the world through the financial crisis. Like, we know how to trade these environments. We know how to rebalance at the right time and build a framework for doing that. And that's why you hired us to take care of this for you.
Cool.
So getting that right is important.
Now, I want to shift the remaining discussion to alternative investments. What is an alternative investment? How would you define it? You specialize in creating a fund. You've created a fund that does alternative investing. How do we take advantage of it through GenTrust, Catenary, and other sources? And why is it important to have alternative investments in a portfolio?
Well, it is.
And this will be the next half hour.
Yeah, no, it's important for some, but not for all. So, the first, while I run alternative investments for GenTrust, and we do a lot of it through a sister business called Catenary, which, well, we can talk about. But, alternative investments broadly refers to anything outside of traditional liquid asset classes. So anything outside of equities, bonds, and futures on commodities and commodity indices and things like that. So it could be real estate, it could be private equity, it could be hedge funds. It's a catch-all term that is mostly used by people in the industry as a way to sell folks on paying higher fees. So
that's a cynical way of putting it.
Yeah. So with that as background, I mean, it's sort of a business model in search of a business strategy. You figured out if you call yourself an alternative investment, you can charge higher fees, and maybe it's useful, maybe it isn't, but you put a lot of money in your own pocket in the process. So we use alternatives sparingly, but we still find they play an important role in our clients' portfolios. So what is that role? It's pretty straightforward. Either an alternative investment needs to, net of fees and taxes, offer substantially better, meaning higher returns, or expected returns, I should say, than what you can get in traditional investments, or they need to offer returns of a completely different character. So something that'll be uncorrelated is the way I refer to it. It's something that equities could go up, equities could go down. It's going to generate return in a different way. Maybe it goes up, maybe it goes down. But the fact that equities are going up or down, or bonds are going up or down, is not going to be the primary or even a minor driver of the performance of an alternative investment. Finding those uncorrelated investments is quite difficult, and that's where I focus most of my time. Sometimes they could actually be negatively correlated. We like to find alternative investments that are what we call long volatility, which means they do better when markets get volatile. And markets get volatile, if this was something people didn't realize until about 1987, but markets volatility goes up when equity markets go down. Straightforward. If you think about calm markets with a lot of forecasting, people are willing to take risk, more money flows into equities, the market goes up. Something surprising happens, it's almost certainly to the downside. People rein in their risk tolerance, and equity markets go down. So if you can find something that's able to make some money but also make a lot of money when markets get volatile, it's probably a good balance to everything else that's going on in your portfolio.
What strategies are working today in alternative investments for you?
So, we have a handful, but again, this is the icing on the cake, not the cake. Recently, there's been we've found a lot of interesting things to do in the private equity realm. So, public biotech is incredibly volatile. and difficult to invest in. But there is tremendous innovation happening at the in biotech, and last year we found, or through a relationship of mine I've had for a long time, we were able to get capacity in a top tier biotech private equity fund that basically starts up private companies that then I think they've had 30 plus exits now, some into the public markets, but some just sold to big pharma. And what we've seen is a tremendous level of innovation, as well as tremendous interest from big pharma to restock their pipeline as more of their drugs go to generics. So that's an opportunity that you can't find in public markets. You just can't get it. So that's an example of something that we think has better returns than what's available in public markets and is different enough to warrant inclusion. Another one-off, again, sort of niche-y, but also private equity we've been investing behind is there's tremendous innovation and momentum and growth behind carbon capture technology. And you have to have sort of the right set of relationships to find your way into these opportunities. But we are in sort of the foremost focused investor in that space that understands the technology, understands the landscape, and has just been doing incredibly well over the last year. They just fully invested their first fund and are now launching their second fund. And so again, those are private technologies that are being adopted very quickly, especially in Europe, given all the momentum behind ameliorating global warming. And that's not an opportunity set available in public markets. In fact, to the extent anybody's gone public in that space, it's gotten way overvalued and SPAC'd and all that kind of stuff. And you probably don't want to own those. But if you can be in the private companies as they're just starting their growth inflection, that's been good. So those are private equity opportunities. I'll give you two other quick examples. One is we seeded a high frequency business in the currency space. It struggled the last couple of years because it's a business that makes more money when markets get volatile. And with interest rates incredibly low and volatility low, especially in currencies, it sort of flatlined down small. But now central banks are starting to raise interest rates, and they're doing it at different speeds. And massive sanctions are going in against Russia, and that's going to affect Europe differently than it's going to affect the US. And so we're starting to see real movements in currencies right at the same time that everybody's equities portfolios are coming under stress. So we think that's a small sliver of client portfolios, but likely to generate attractive returns at a period where other things in client portfolios may struggle. So that's a hedge fund that we think is particularly interesting. And again, it's a hedge fund. A lot of hedge funds lost money in January and February. Well, you were paying them a lot of fees, and they lost money along with the equity markets. That's not actually that useful. But paying somebody fees to build out a high frequency business that's going to do well when the shit hits the fan, pardon my language, in the rest of your portfolio, that could have value, especially as we're trying to make sure we have the right level of risk on for clients, especially for clients who are more risk averse, I'd say. And then the last one is we've been an early and consistent investor in a portfolio of rail car assets, not as illiquid as private equity, the biotech or the other investments I talked about, not as high returning either, but incredibly tax efficient for a variety of reasons that's probably beyond the scope of this conversation, and offers a very attractive yield. So, it's 10 to 14% net returns, tax deferred essentially, almost like you invested in an IRA, incredibly stable and economic, resilient to the broader economy, again, for a variety of reasons that's beyond the scope of this. And, from our perspective, that sort of is a good one to talk about how we think about adding alts to a portfolio. The underlying risk is really credit risk. Well, investment grade bonds, and it really, investment grade credit risk essentially, and investment grade bonds are offering low single digits, and this is offering 10 to 14% net. Okay, well, it's better. Yeah, but it's illiquid. You can sell your investment grade bonds anytime and rotate them into something else. So that has real value. And so you move into the rail car because it's better, but it has to be substantially better to warrant the illiquidity.
That's a great summary. And what Eli Cohen has just told us is investing is not as simple as picking stocks and bonds and putting them in a portfolio. It's measuring risk, it's analyzing risk of the investments and being able to do it in a way that's very sophisticated, which is something that GenTrust has done since its inception and continues to do for its clients. And that's why they present a unique alternative for the investor in the marketplace today. It's not just your average registered investment advisor that's picking ETFs or something like that. You really have to evaluate risk. You have to understand risk in order to do it the right way, to invest in the right way. And that's why they have sophisticated investors that rely on them for investment advice. So this has been a great tutorial. I really appreciate your time today and teaching us about not just the markets in general, but about alternative investments. Thank you.
Sure, happy to talk anytime, Wayne.
So we've been talking to Eli Cohen of GenTrust. If you want to know more about them, then you should visit their website, which is GenTrustWM, right?
That's correct.
.com. And by the way, stay tuned for an educational moment where I'll break down into very simple terms what alternative investments are, trying to simplify some of the things that Eli was saying, but not too simple because it's really complex stuff. So stay tuned for our educational moment. Thanks for listening to Blueprint for Wealth.